What's up, everybody? Michael Silva here. You are watching the Stock Market Brief Show, and in today's video, we got a lot to dissect. Starting with the CPI data and how the market responded to that, we're going to go over some intermarket assets that are very important to keep an eye on because it could provide insights into potential changes in trend in the overall market direction. We're going to also journey into some seasonality charts, but that's not all. Stick around and we'll identify some key support and resistance levels, both bullish and bearish, to help navigate this complex financial landscape. We're also going to explore the potential for a significant move, unveiling a hidden level and discussing how the market might be poised for that game-changing shift. So if you haven't done so already, make sure to grab your notepads, get your screenshots ready. We got a lot to cover. Let's get into it. Alrighty, people. Welcome back to the show. So we got that inflation data out. And as expected, we got a lot of volatility and a lot of whipsaws. So what actually came out as far as the data? Well, you can see a couple of things. If you take a look at this column over here, as the consensus was 0.2 for core inflation rate month over month, we actually came in hotter than expected. Interesting. Inflation rate month over month came in as expected. Inflation rate year over year, this actually came in hotter than expected. This is the one that includes food and energy. Core inflation is the one that strips it out, and this came in at consensus as well. So we did get some hotter than expected numbers. How did the market digest this? Well, you can see here, the market didn't do much on the day, unless if you're paying more attention to small caps. The IWM, by the way, is currently dead. Maybe it'll wake up here. Been a while though. As you can see, we have the IWM. It's been kind of hanging around that 200-day moving average. I know a lot of people will be looking at this and saying it's a head and shoulders potential topping pattern. They'd be absolutely right if the 200-day starts giving way. We did have some strong volume there, okay, in this break of this tiny consolidation, but there needs to be follow through. Now, there's a possibility, though, that we're very near the low of the month so far, and we still have a lot of time left, so either there's going to be a significant catalyst to break it, but I will show you what I mean momentarily. Now, if we take a look at the 11 sectors that make up the S&P 500, the one up the top was utilities. This is important to note because utilities is starting to, well, gain some momentum, and if that's the case, this is more of a risk-off asset, and seeing it start to pick up could be bad, potentially, for the overall markets. If you take a look at the heat map, a lot of green on the board today. However, it was Apple that was down big. Well, I guess 1%, right, would be technically down big, I guess, if you really... Netflix was down 5.17%, so that took a big hit there as well. But you had Microsoft up, Nvidia up, Google up, Meta up, Amazon up was up big, and Tesla too. So Apple, it really does hold some weight in the overall markets. Now, if you take a look at some of the top 50 stocks that made new 52-week highs, and we're looking at, highest market cap to a little bit lower, but we're looking at mid-size to megas, okay? So you can see here, Amazon and Berkshire Hathaway are up in the list, along with Visa and Walmart. These are all names that hit new 52-week highs today. Remember, the saying goes, strong stocks typically get stronger. So I would be pulling up these charts and looking for areas of consolidation for potential stronger moves to continue to move to the upside. On the flip side to that, you can take a look at the new 52-week lows, and there was a lot of them that were forming. You can see a lot consumer defensive type names, and a lot of these names right now I've been paying very close attention to. And the reason why is because you can find beaten down names for potential bounces if you're more shorter term. It's all about trading within probabilities, and when things get very overextended, things can continue to get overextended to the downside. But there are key elements that you can watch for. For example, we look at the 5-day moving average. If price can get back above that, we might see a continued bounce. But you got names such as some familiar ones, Dollar General, DLTR. These are two that are on my watch list right now. Still very close. I've seen them price tightening up. It looks like it was going to break out, right? When price contracts, it expands. This one broke out slightly and then kind of made another low today, obviously, as I'm pulling this chart up. But these names, if I pull up some of the charts, what you'll notice here is like DEO, bam, it's way down there. JD is an internet retailer, but that's a Chinese stock. We have Chewy down here that's just been getting hammered. Just all these names that we're talking big mega cap names too. Look, I mean, look at DG, like look at this thing. So it was getting all tight right here, but then we had a pretty large move to the downside today. Kellogg, right? K, I believe that's Kellogg, is down pretty big over here. So a lot of these names have just been completely getting beat up. Another one is Hershey, HSY. That'd be one that I'd want to bring up on the radar. Another one that's not on this list right here is WBA, I think it is, which is Walgreens. I saw names like CVS get big bounces from, selling off. So these are just names. Look at SJM right there, which is, I think, Smuckers. LUV, right? That's Southwest, I believe. So you're just talking a lot of names have been getting just completely hammered here in the month so far of September. And September is notoriously a weaker month. Now, if we take a look at some of the intermarket assets, take a look at the 10-year yield. We did gap up today. We have what's known as a bearish engulfing or an outside trading day. And that is, could be potentially bearish, but overall, look at the context of the chart, right? We broke out of this area, we broke out of the area, we backtested, we moved up, and we've kind of been following along this trend line here. When we last tagged it here, we were talking about as it was pulling in, careful, because we might bounce up. And now what I'm paying attention to here is we have a high and a lower high with this. So it'll negate this bearish outside candle if we get above the high of today, which is 43.44 on the TNX, which in the 10-year yield, that's 4.34%. And then you might look at this back, if it does break this trend line, you have this little type of head and shoulders potential, which means it could come back down to around, probably around this 3.94% range before potentially seeing some sort of a bounce there. So if that does take place, that could offer up some relief in some various assets. If we take a look at the dollar, though, the dollar is still holding pretty strong here. It looks like it's flagging. We haven't really seen a breakdown or a consolidation even at that point, right? We moved up strong, a little pullback here, and now we're kind of flagging again. So if we get some weakness in the dollar, that could provide some real big relief in assets like gold, potentially even the stock market. As we've been noting, this has been going up. S&P 500 has been turning down. When this goes down, we've been seeing the S&P 500 go up. So are we going to see some sort of flight to safety or catalyst and the dollar just breaks out and starts moving very quickly? If that's the case, it could be potentially very, very bad for markets and other various assets too. If we continue on, tomorrow we do got more data coming out, and this is getting pretty interesting. So Thursday and Friday both are going to be some big economic type data points coming out. And when we get into some of these charts, it looks like the market's wide open for a very significant move. And we'll really walk through those key levels of what I'm paying attention to. And we'll get into that momentarily. But yes, PPI, retail sales are coming out tomorrow, right? That's an hour before the market opens up. So just be aware that we can see some volatility. We always see volatility at the beginning of the day, but right before the market opens up, we'll pay attention to some of these expected moves that we're about to go over. If I take a look at the DEX, which is the daily sum of delta from options flow across the entire market, I just want to call out that today we landed in the red, so we have more of a bearish bias going into tomorrow. This is not always 100% accurate, but if you do run the back test, which I have done on multiple different series, it over time it does help. So if it is a bearish bias and we start up at the upper daily expected move or something like that, you can look for higher lower highs, lower lows to break down and potentially play it lower. But if we start way down lower, it's not something that I would just short into blindly. You'd have to look at the charts to really determine, your risk versus reward. Now, if we continue on and look at the summation index for the NASDAQ is now 2 days of a potential change in trend as price is kind of going sideways as it stands. The NASDAQ McClellan oscillator is below zero. No overextended readings yet. We talked about the overextended here, remember? And then we started getting this little fish hook here. And we said, hey, don't be surprised, right? If we start getting a bounce, it could happen. Boom. We bounced. It happened. Now take a look at seasonality. We're now going into the 9th trading day of the month. And yes, typically seasonality from a pre-election year starts out weak in September, right? And it ends weaker, but we do typically get some sort of a rally, which we just haven't gotten yet. So this weakness, is it being pulled forward potentially, or is there still more weakness to come? And I'll show you where we stand on the monthly charts momentarily. But if I look at NASDAQ pre-election year, so you can see the purple is the current year, the blue is the pre-election year, and this is going July, August, and then the month of September to October. So we're right here. in the month, and we're more towards the center right around here where we can still see a potential move up higher, and then it typically gets weaker into the end of the month. And you'll notice that there are, you can see the aggregate cycle, you can see which is the red, and then the black is all years combined, which is, it's kind of hard to determine. That's kind of just flat. So typically what this means is if you aggregate all the data, it's weak. We're just kind of in a period of weakness. But then towards the back end, November, right, and December, right, you typically start getting a little bit stronger towards the end of the year there, which, towards the end of December, right, you get year-end markup, you get all the, that saying, you get the Santa Claus rally, people start talking about that. So, there's still potential for the market to rally higher, and there are some hidden little levels that we'll go over. If you take a look at the S&P 500, which is just an inside trading month, and despite seeing all the volatility so far in the month, it's only down 0.89%, and we're still above that 5-monthly EMA as it stands. Now, if we take a look at the Qs, we're down 1%, so slightly a little bit more than the S&P 500. We have not reconnected with the 5 EMA. That is upward sloping. So if we do come down, pay attention to that level, which is around 365.31 as it stands this moment, and we're still within the monthly expected move, quarterly expected move there as well. Now, IWM. This is why I kind of brought this up to see, hey, like, is the dead IWM, is it going to wake up, right? Are we going to open up these eyeballs here like this, all of a sudden grow some hair and say hello to the world? We'll see. But the reason why I'm saying that is because we are near the lower monthly expected move. So the market priced in this move as far as last month's close. So last month's close was right here, and then said, hey, going forward, into next month, I think that we're going to see around this much risk. And remember, if you think of this as a distribution curve, 68% of the time, the market's right? And it closes within these, and it typically tags one of those as well. So as we're coming here, now remember, last month, not like even in the Qs, right? See the Qs, how it came all the way down? This was actually trading outside, and we were talking about, okay, there's a higher probability that we're going to get a bounce, and that bounce came, right? And that was also with the S&P 500. It was getting outside the monthly expected move. This is this month's expected move right now, but I had last month on the prior month, and then it started to bounce from those levels. The IWM did it, you can see right here, and it closed basically on it. And now as it stands, we're basically at that level. So as everyone's talking about this head and shoulders pattern, either we need some sort of catalyst or something to really just press it down, but we're right around that lower monthly expected move. So if we break out, everyone's going to start talking about it. But what if it just does something and just tricks, the crowd out? That's always a possibility. We got to be open to it as it's been getting beaten down. But just be aware, overall, the trend right now, it's above the 200-day. It's rather neutral, and price hasn't really gone anywhere. So something to just keep a close eye on. Now, I think that the market has a high probability of a very explosive move this week, so we need to be aware. So I'll tell you why. If we take a look at the 5, 10, 20 timer, that's taking the 5 EMA, the 10 EMA, and the 20 EMA. We can just identify, potential changes in trend looking at this. You can see they're all squished together, right? Like a peanut butter and jelly sandwich just squished together. And you can see it's compressing, all right? And we talked yesterday about the possibility of you see this little left shoulder, head, right shoulder potentially breaks out. That's a possibility. But I want to overlay the weekly expected move to the SPX. And as you can see, we haven't really gone anywhere on the week. So if we were to make a move, right, when things coil up and get tight, like they're doing right now, remember, expansion leads to contraction. Contraction, which we're doing, leads to expansion. And we still have a wide open weekly expected move. So to see it come up here to over 4,500 or to come down here to around just over 4,400, that is a high possibility to see that happen within the next 2 days. Now, we need to be aware of levels on the smaller time frames to really kind of zoom in. Now, we're on this theme of aliens right now. This looks like an upside down UFO, and what I'm pointing out here is you just have a pretty tight channel, then we broke out of it, right? We actually gapped out of it, and then we gapped back into it. Very weird structure overall. But when I'm looking at this, throughout this area as we're coiling up, it's also in confluence with a lot of key levels. Those key levels are the month-to-date anchored VWAP, as you can see right here. week-to-date anchored VWAP right there, the green line, which is the quarter-to-date anchored VWAP, and you have the 5-day moving average. So if I were to just clear the screen back up again, my thought is this: if we can break out and get above this high right here, and or this high, right, that opens the door to break out to head higher. That could give us the momentum where you can say, hey, now I think we're going to start making a move. I'll have a stop loss down here, maybe even here. It depends on your risk and where you think the market can potentially go. If we do get that breakout, I'd be looking at that upper weekly expected move as a possibility. Okay, now with that said, when I'm looking at where price stands now, we're below those levels. And we have a declining 5-day moving average. It's actually starting to flatten out now. So we have 1 day, 2 day, 3 day, 4 day, 5 days. So this is good. We're going to be losing this data right here. So this is going to start to flatten out to turn up more tomorrow. So as long as we can clear these levels and this starts turning back around, right, we get this little saucer type bottom, that would be a very positive sign to potentially aim our sights at that higher level if you're bullish. Now, if you're bearish, if we start taking out these lows over here, that's where you want to just say, you know what, give it some time. Remember, when we broke down from this, came down here, the entire time from this, we caught a lot of great stocks. Well, I guess in the Discord, if you're in that, but a lot of great breakout stocks, a lot of things worked out well. But when you get under a 5-day moving average with something like the S&P 500, a broad market, it's a market of stocks, understand that when this is declining and price is kind of consolidating, you get less breakouts, you get less setups, and that's just the case. So if we start to break out and this starts to turn back up again, it could be very positive for some various swing trades. But just, be aware that there's also seasonality, right? And there's a possibility of breaking these lows to come test this low and then potentially even reach down there for that lower weekly expected move. Now, that 5-day moving average, if I zoom out, I want to just show you how important it is, right? Notice how almost algorithmic this is. Like, so if we look back here to, July, what you'll notice is here, there was a time where we were just kind of holding on and holding on. We came outside of it, but it was still inclining. So this was bearish, but with caution, and we got back above and held, and then we started breaking it, and we said, okay, it's still inclining at this moment. It's bullish with caution, or bearish with caution, but then it started declining. It's like, okay, yeah, it's bearish now. So as we came back up, we retested it and declined. We declined. Why? Well, it was the trend was down. And then it wasn't until here where we started, when we got way above this shot, that was a good, this is why you don't want to chase, right? You got a strong move into a prior area of resistance, and then it was a strong move, so you don't want to chase. It gets faded, okay, and then you're like, oh, no, it's coming back down. But the 5-day moving average at that time was turning back up. We got back above it, which means we can be bullish, and boom, we saw that explosive move. And this is the chart that I recently showed you, and you can see how the 5-day moving average is trying to get itself turned back around. But remember, this key level 445 over here, there's a big volume shelf profile. It's hacked as resistance. Now it actually acted as kind of a level of support right here and right here. So if we can hold that level and this starts turning up and this starts curling back, that opens the door for that breakout moment to head higher. That's the way that I'm looking at it from a bullish perspective. And I think it's possible, okay? I don't know if it's probable, but I think it's possible. And when I think that something's possible, that means I'm going to take I'm going to take the shot if the trade actually goes in that direction. If it doesn't, then I don't take the shot. That's just how it goes. Now, there's also some other signal charts that lead me to believe that we can potentially start turning around. You have a high, a lower high, and a low and a lower low. So you have a positive divergence forming in the RSI of the bullish percent index for the NASDAQ composite. Now, I think that this should start turning back up, would be a more positive sign, and it's not right now. The bullish percent index for the NYSE is still pointing down, but you can still see a positive divergence for another broad market. The BPOEX is starting to turn back up with the positive divergence. The BPOEX is the S&P 100, okay? So that's like the top 100 stocks in the S&P 500. And if you look at the BPSPX, which is the bullish percent index for the S&P 500, it's still pointing down the RSI, but you can see a higher low, a low, and to a lower low. So you do have that bullish divergence. Sorry, I get my words always chopped up. And then you have consumer staples is another one that I find interesting. A lot of those names that I pointed out earlier making new 52-week lows. Consumer staples is getting pretty hammered, and we do have a positive divergence forming there. So I do think that if we do get a bounce, I think those are some of the names that we can potentially play intraday to a very short swing trade, but you just got to be very tactical because, you know, strong stocks, they get stronger. Weak stocks, they can get weaker. But that doesn't mean that you can't find opportunities. Now, I showed this chart earlier. This is ES, the E-mini S&P 500 Index Futures on the DEES contract. And I'm pointing out this level way the heck up here at around 4,800 to 4,805, which is this prior area of resistance. Some people might think that that's absolutely crazy as we're building out a head and shoulders pattern. But like we previously stated, if it breaks out, we might get some crazy momentum on some news that the market wants to jam it higher. Would that be crazy? I don't know. But there are contracts hiding up in that area. And it's been, if I take a look back down to around September 10th, September 11th, 800 contracts at around 48.50 hanging out. And the longer they stay there, remember, they can potentially act like a magnet. Now, that's a long shot off, okay? But if it can hold there in that level, and by the way, this is Bookmap. If you don't know what this is, I have a link in the pinned comment. They offer my subscribers a discount, but it allows you to really see behind the candlestick. It allows you to see where there's orders hiding out. So it gives you more data to create more. You know, I like using it because it gives me better risk to reward trades where I play at key levels or wait for certain levels to break. And I have a couple YouTube shorts on it if you want to check that out. But back to here, 800 contracts on ES is quite a bit, right? Everything down here, you can see where price is kind of at, not that much, but 800 up here, the longer it stays, it becomes noteworthy, okay? And the reason why I say that too is because if you look at this chart, see this gray box over here? That came with 18, that was actually like 1,900 contracts. Okay, so this one's only 800, but this gray box was 1,900 contracts when we were over here. And then we started pointing it out. And if you don't believe me, go look at the videos or go look at my Twitter where we posted it basically, I think, on August 2nd. And as you can see, price literally just came down, absorbed the liquidity, bounced around that level, and we started to move down. So is it possible? Yes. Probable? I don't know. But are you willing to execute if opportunities show up, meaning we start to see breakouts? And by the way, if it breaks out and it comes right back, there are risk parameters you need to take in order to make sure that you don't bust your account. That's all I got for you on today's episode. Everybody, see you later. Bye.